So 114,000 jobs gained privately, according to ADP. Hugh, I was just about to say that your prediction was a little bit higher than this.
Yeah, my prediction was higher. It's obviously a number that is almost impossible to forecast. So I think if you look at the number and you ask yourself the question, what's it going to do to trading today? Well, it's a little better than expected. It tells you that private sector employment for the month of July was a little bit better than expected, or it's going to show an increase. And I suppose on balance, you have to look at that as being positive for trading today. But as everybody has pointed out on your program before, there's really not a month-to-month, a tight statistical relationship between the ADP report and the numbers we're going to see on Friday. But nevertheless, let's take it as somewhat positive news.
Right, and I'm looking at the market reaction right now. You're seeing a slight tick back up in equity futures. Mike, what more do you have on these numbers?
Well, not a whole lot right now. At this point, we're still waiting for the total numbers to come out in terms of the largest and smallest companies. What we've seen in the past is that the small companies have added the most when ADP comes up with a big number. This is approximately where we were last month. The interesting thing is going to be to see how well it compares with in the service industry sector with what we see from the ISM number coming out at 10 o'clock this morning. We got a bad number from the manufacturing side. We'll see if we add any service industry jobs.
So then, Hugh, if you were, as Mike is waiting for more numbers, and I'm seeing a revision now from the prior month to 145,000. It's a bit lower than the number of jobs that ADP said were created in the prior month. If you had to be in the markets today, if you're trading today, then you see a number like this, what do?
Well, I think what you do, you may, if you have some courage, you may be on the buy side or expect a little bit of a bounce, particularly as was mentioned before. We've had 7 days in a row of the market being down, and it's at levels that are arguably undervalued. So you might play it with a positive bias today, but keep in mind that the important number's coming up on Friday. So you don't want to make a big bet today. You want to make only a small bet and wait for those numbers on Friday, because those are the ones that are going to make the difference for the next 2 or 3 weeks.
Right, the employment report, the government report. Scarlet, as I mentioned, equity futures just ticked up a little bit, but what are the other markets doing?
Yeah, we also saw treasuries turn around a little bit, and there is now more selling. Well, actually, they're moving right back again. The 10-year at 2.59%, so just below 2.6%. It had come up a little bit, but it's right back to where it was before that ADP number came out, and the 2-year is also little change at 32 basis points, and not much difference in the currency markets as well. Dollar yen and euro dollar pretty much where they were before. But Hugh, I do want to ask you about this sense of how much the market has priced in a second half recovery, because most people expected Congress to come out and eventually raise the debt ceiling, which it looks like they will do and have done. But this sense that the second half recovery was still coming along kind of got dashed with the ISM manufacturing numbers and, of course, yesterday's numbers as well.
Yeah, it's very much the second half is very much in doubt now. We're even hearing talk about a double dip, which is a distinct possibility. You heard Martin Feldstein. He's very bright. He understands what's going on. So I think you really have to say that we've stalled out, and it's not so clear now to me that the so-called soft patch that began in May is transitory, as Chairman Bernanke has said it was. It looks to me like it's much more permanent. So there are deep concerns, and what you're going to see over the course of the next 2 months is economists like myself revising their forecasts downward, which is very, very troubling. So we're right on the brink.
And then you've got strategists, investors like Barton Biggs this morning, who says that he'd be buying aggressively in a market like this because valuations are so attractive now. Hugh?
The one thing you can't do in this business is ignore the message of the markets. And the markets have been going down. Investors have been shifting to the safer sectors of the market. To some extent in your portfolio, you have to shore up defenses. And that may mean something very simple, like adding to your so-called safer sectors, like healthcare, utilities, consumer staples. But you cannot ignore the performance of the market, which is sending you a message that things are not as good as we thought they might be.
Hugh, just quickly, though, this talk about a downgrade, right? We were just discussing that in the prior segment. Is any of that going to really affect the markets?
I don't think so. And I think for one of your prior comments that was made was that, look, you know, I don't think there's any question about the safety or the ability of the U.S. government to meet the interest and principal payments on its debt, no matter what the rating of the U.S. is, according to Moody's or S&P. So I, quite frankly, ignore that. I don't treat it seriously.